Welcome to the deep dive. Ever been curious about what's really going on with those big companies you hear about, the ones whose stocks you can actually buy a piece of?
Mm-hmm.
Think of this as us, well, popping the hood on a really well-known business today. It's Tesla, ticker TSLA, just to see what makes it tick.
Right. And maybe get a sense of where it might be headed. And
Exactly.
we've got, a bunch of recent analyst reports here. Think of them as expert takes, really digging into Tesla's current situation and forecasting what might be coming.
Yeah, and what's really interesting right away is just how different these takes are.
Oh, definitely. It kind of highlights that figuring out a company's value, its future. Well, it's not simple, is it?
Not at all. We're seeing everything from like buy ratings to predictions of pretty strong underperformance, plus the hard numbers, of course, and what the analysts see coming up.
So our mission really is to take all that analysis, all those opinions, and sort of boil it down for you. Get to the key insights without all the Wall Street jargon.
Exactly. Ready to dive in?
Let's do it. So first off, maybe just a quick refresher on Tesla itself.
Good idea.
Founded way back in 2003, went public, I think it was June 2010, at $17 a share.
Wow, $17.
Yeah. And since then, obviously, they've become this huge player, not just EVs, electric cars, but also energy generation storage systems.
Right. The power walls and
Ex-
mega packs.
Exactly.
Yeah.
They've got roughly 49,000 employees. And they recently moved their headquarters, from Palo Alto down to Austin, Texas.
Yep, saw that news.
And importantly, they're part of the S&P 500, which is
Yeah.
basically, the club of the 500 biggest U.S. public companies. So a major, major company we're talking about.
Definitely a household name. Okay, so now let's look at how Tesla's been doing recently, because this is where, like you said, it gets interesting with those different expert opinions.
Right.
We saw one report from Argus giving Tesla a BUY rating. What does that actually mean in simple terms?
Well, a BUY rating basically means that analysts or that firm thinks the stock is probably going to do better than the overall market average, usually over the next, say, 12 to 18 months. They're essentially saying, we think this is a good place to put your money right now.
Okay, makes sense. But then you look at another source, Schwab equity rating, and they have an F, which means strongly underperform. I mean, how do you square those two? They're complete opposites.
Yeah, that's the million-dollar question, isn't it? Schwab's F rating comes from their quantitative model.
Ah.
It's like a computer program looking at tons of data.
Okay.
Things like growth trends, financial quality, investor sentiment, stability valuation, all crunched together. And an F suggests their model sees red flags, predicting the stock will do, well, significantly worse than the market.
Wow.
So yeah, this massive split right off the bat really shows the complexity, the different ways you can slice and dice the same company's data.
It really does. Okay, so let's dig into the actual numbers for the first quarter of 2025. Maybe that sheds some light. Looks like profits took a bit of a hit compared to last year, right?
Exactly. Q1 2025, their adjusted net profit was $934 million. That's 0.27 per share.
Yep.
Compare that to Q1 2024 when it was over $1.5 billion or 0.45 cents per share. So a pretty noticeable drop.
And what were the main reasons for that drop?
The reports point to a few things mainly. Lower revenue overall. They delivered fewer vehicles. And their gross margin, that's kind of the profit they make on each dollar of sales before other expenses, it was softer.
Got it. So less money coming in, fewer cars going out, and less profit on each car.
Pretty much, yeah. Total revenue fell 9% overall.
Yeah.
And the automotive part, the main car business, that revenue was down 20%.
Ouch. But wasn't it a mixed bag? I thought some parts of the business actually grew.
You're right, it wasn't all negative. While car revenue dropped, their energy generation and storage division,
Yeah.
The power walls, the mega packs we mentioned, the revenue surged up 67% to $2.7 billion.
Wow, 67%. That's huge.
It really is. And their services and other revenue stream was also up 15%. So yeah, definitely a story of struggles in the core auto business, but real strength elsewhere.
Okay, and the actual number of cars delivered, that's got to be key for a car company. What did that look like?
They delivered, 336,681 vehicles in Q1 25. That was down 14% compared to the same quarter the year before.
Down 14%. Any specific reason given for that slowdown?
Yeah, one of the big things mentioned was a production line switchover. They were apparently retooling factories to get ready for new versions of the Model Y.
Ah, okay. So potentially a temporary dip while they gear up for something new.
That seems to be part of the explanation, yeah. That kind of changeover can definitely slow things down for a bit.
Okay, so a dip in car sales, maybe temporary, but this real boom in the energy side. Now, what about looking ahead? What are the analysts predicting for Tesla's future?
Well, Argus, the firm with the BUY rating, despite that weaker Q1, they're still pretty optimistic overall. Yeah. They think Tesla can navigate what they call a challenging EV market right now and actually come out stronger. They seem particularly positive about the plans for a refreshed product lineup.
Including that much talked about affordable car, the Model 2.
Exactly, the Model 2. They see that as a big potential driver. Argus also points to the more, let's say, futuristic projects.
Like the robot taxi and the robot.
Yeah, the Cybercab, there's an autonomous taxi concept, and Optimus, the humanoid robot. Yeah. Argus sees the as potential positive catalysts, even in the near term, still talking about 2025 progress.
Interesting. So they see big things coming.
They do. They acknowledge that EV sales growth across the board has moderated a bit, but they think the long-term trend is still solid, still upwards.
But didn't they lower their price target?
They did, yeah. Even with the optimism, they revised their target price down. It was $488, now it's $410.
Rather cut.
Mainly because they slightly lowered their revenue forecasts for 2025 and 2026 by about 7% each year. So still positive, but tempering expectations just a bit on the near-term money coming in.
Okay, so still bullish, just slightly less so on the immediate revenue. Now, what about the other side? The more cautious voices, like Schwab's model or CFRA.
Right. Well, Schwab's F rating, as we said, comes from their quantitative model pointing to underperformance. And then separately, there was news that CFRA, another research firm, actually downgraded Tesla after these Q1 results.
Downgraded from what?
From a buy rating down to a hold.
And hold means?
A hold basically suggests they think the stock will perform roughly in line with the overall market. Not necessarily bad, but not a strong buy either. Kind of neutral.
Got it.
And along with that downgrade, CFRA also lowered their price target and their estimates for Tesla's earnings per share for both 2025 and 2026.
And their prediction was pretty stark, wasn't it? About getting back to previous profit levels.
Yeah, they're now saying they don't expect Tesla's earnings per share to rebound back to the levels seen in 2023 until at least 2027. So that's a longer-term caution creeping in.
What drove that change for CFRA? Was it just the Q1 car sales dip?
It seems like that was a major factor, yes. Similar concerns, lower expectations for auto sales volume. This was despite acknowledging the strong energy storage performance and noting that Tesla might have less exposure to international trade tariffs than some competitors. But the weaker car sales forecast seems to have tipped the balance for their short to medium-term outlook.
Okay. And what about Tesla themselves? Did Elon Musk or the company give any guidance, any forecast for the rest of the year?
Well, interestingly, no. After these Q1 results, Tesla specifically didn't provide forward-looking financial guidance.
Really? Why not?
They cited difficulties in assessing the impact of shifting global trade policies, basically saying things are too uncertain right now with supply chains, demand, tariffs, that kind of thing.
So just wait and see.
Pretty much. They said they'll revisit giving guidance maybe after Q2 results. They did mention, though, that future growth really depends on several big factors.
Like what?
Things like how fast their full self-driving tech accelerates, how quickly they can ramp up production of new models, and just the general macroeconomic environment, the overall economy.
So lots of variables, lots of uncertainty.
Definitely sounds like it.
Okay, let's shift gears a bit. Talk about some key numbers people look at. We saw slightly different figures for Tesla's total market value, its market cap. Why would that be?
Yeah. That's almost certainly just down to timing.
Yeah.
The reports were likely finalized on slightly different days, and the stock market, well, it moves constantly. So the market cap, the total value of all shares is just a snapshot, and those snapshots were taken at different moments.
Makes sense, like taking a picture a few seconds apart. Now, Argus, even though they lowered their target price to $410, that was still way above where the stock was actually trading when they wrote the report, wasn't it? Something like $250.
Exactly. So even with the reduction, their $410 target still implies they see significant upside potential, like a lot of room for the stock price to grow from where it was.
And they noted the stock's recent range.
Yeah, Argus mentioned a 52-week range of about $214 to $292 based on their report date. Schwab's data actually showed a much wider range over the past year, from around $141 all the way up to nearly $489. Shows you the volatility.
Definitely. And Argus made that really interesting point. Don't just value Tesla as a car company.
Right? They really emphasize that. They argue you have to factor in the energy storage, the self-driving software potential, even robotics with Optimus. These other ventures, they say, are a huge part of the company's potential value.
And they made that bold claim about profitability, too.
Yeah, that Tesla is currently the only profitable EV maker globally, even including all the companies in China. That's a strong statement if
It
true.
really is. Now, looking at some valuation metrics from Schwab, that price to earnings ratio, the PE, it looked really high compared to the average big company.
It did. The PE ratio, just quickly, it's how much investors are paying for each dollar of a company's past earnings. Schwab's data showed Tesla's PE was nearly 157,
Okay.
while average for the S&P 500 companies was only around 42.
So, like, almost 4 times higher? Why so high?
Well, really high PE like that often means investors have massive expectations for future growth. They're willing to pay a premium now because they expect earnings to skyrocket later.
Right, betting on the future. But what about the actual forecast for future earnings? Did that match the high PE?
Ah, well, this is where Schwab's caution likely comes in stronger. Their data highlighted an expected decrease in Tesla's earnings per share over the next year, down almost 13%.
A decrease, while the average company is expected to grow.
Exactly. Schwab showed the S&P 500 average forecast was for over 20% growth. So you have this high PE suggesting high growth expectations, but then a forecast showing earnings actually declining in the near term. That mismatch is often a red flag for quantitative models like Schwab's.
Yeah, that makes sense. If the price is high based on future hopes, but the immediate future looks bumpy.
Yeah, it can make the stock look less attractive valuation-wise.
Okay. And dividends. Is Tesla paying shareholders anything?
Nope. Argus noted Tesla doesn't pay a dividend currently, and they think it's unlikely to start anytime soon.
And buying back shares. Sometimes companies do that to boost the stock.
Argus mentioned that too. They said any plans for share buybacks are probably delayed, maybe pushed back to 2025 or 2026, likely because of the current business environment and wanting to conserve cash.
Right. Okay, what about just the overall financial health? Is the company on solid ground financially? Argus gave them a rating for that, didn't they?
They did. Argus rated Tesla's financial strength as medium-high.
Which sounds pretty good. What backs that up?
They pointed to a few positive signs. Tesla's total debt actually decreased compared to the previous year,
Okay.
and their cash and cash equivalents, the money they have readily available, that increased. Plus, the cash generated from their actual operations also went up. So less debt, more cash, generally good indicators of financial stability.
But still, there are always risks, right? Especially for a company like Tesla.
Oh, absolutely. Both reports mentioned the usual suspects. A weak global economy hurting car sales, changing consumer tastes, maybe people shifting away from EVs temporarily, higher costs for raw materials like lithium or components like chips.
Manufacturing problems, too.
Yeah, manufacturing disruptions are always a risk. And Argus also kind of reminded us that despite its size, Tesla's still relatively new compared to the legacy automakers operating in a very established industry.
And Schwab mentioned volatility.
Yep, Schwab specifically noted a high price volatility outlook for the stock, meaning expect potential big swings, up or down.
Okay. And one last thing, ESG, environmental, social, governance. Schwab had a rating for that.
Right, that came via MSCI, a big ESG rating provider. They gave Tesla an overall score of BBB, which is classified as average.
Average. How did it break down?
They rated Tesla as a leader on environmental factors, which you might expect given the EV focus.
Makes sense.
But they flagged Tesla as a laggard on social factors and average on governance, which covers things like board structure and shareholder rights. So a mixed ESG picture.
Interesting. Okay, so let's try and wrap this up. Bringing it all together, it feels like we have this real split decision from the experts on Tesla right now.
Definitely. You've got Argus still saying BUY, seeing past the current dip, banking on things like the Model 2, Cybercab, Optimus, the energy business,
Yeah,
even though they trimmed their price target a bit.
right. But then on the other side, you have Schwab's model screaming strongly underperform and CFRA pulling back to a more cautious hold, both raising flags about near-term profits and those weaker car sales numbers.
Exactly. It seems the big questions really circle around how much weight do you give that recent earnings dip? How real and how soon are those future products and AI ventures? And what's the overall health of the EV market going to look like in the next year or two?
It really does highlight that analyzing a company, especially one this complex and frankly controversial, it's not just about plugging numbers into a spreadsheet.
Not at all. It involves weighing quantitative data, qualitative factors, future potential, market sentiment. And like we saw, even the pros looking at the same info can come to very different conclusions.
It really makes you think, doesn't it? If you were looking at Tesla, What would you focus on most? Is it the current bottom line, those profit numbers? Is it the potential game-changing tech down the road? Or is it more about the big picture, the whole EV transition?
Mhm.
Hopefully, this deep dive gives you a better feel for the kinds of things analysts consider, the debates they have, and maybe encourages you to, dig a little deeper yourself and start forming your own informed views.
And maybe the key takeaway is just how dynamic this all is. The story for a company like Tesla changes fast. What we talked about today is based on the latest reports, but check back in a few months, and the picture could look quite different again.